All right, you guys. My name is Jason Malabute. This is my partner, Charles Steven. We are going to start with the video, but first I want to say thank you so much for joining us today, and please leave your contact information in the chat. Also, if you have any questions, feel free to ask them, and then I will answer them as we go. So let's get this party started. Okay. I do apologize, you guys. Seems like it's still loading. Okay, you guys, so we'll just get on to the next part. We're having technical issues with the video, so let's proceed. Okay, as mentioned, this presentation is about Archway Apartments. It's a 106 unit building in Riverdale, Georgia, which is just south of Atlanta. Okay, so here's the confidentiality disclaimer. I strongly encourage everybody to watch this and not to review this. I just wanted to make it clear that this is a 506c offering, so that means that this is only available to accredited investors. Okay, so here is a table of content. First thing we're going to do is I go over the sponsorship team. Next is a market analysis. Next we'll go with a property description and highlights, business plan, asset management services, and then the next steps, and then we'll answer any questions that you guys might have. Alright, so let's go over the sponsorship theme. Always remember, you guys, that whenever you're investing in a deal, the most important factor is a sponsorship team. So let me introduce Cashflow Champs. Cashflow Champs has over 50 years of combined real estate experience. Cashflow Champs is led by the one and only Charles Seaman. So Charles, would you like to go more into depth
Sure.
about
Jason, thanks so much for the introduction. So, what you can see on the slide here is a whole bunch of handsome faces, and aside from just good looks, we also like to bring some expertise and some skill. One thing I could assure you is that we're definitely a little more apt on the real estate side than we are the technology side. So don't let the video at the beginning be an indication of your judgment of our team. So for me, as Jason said, I'm Charles Seaman. I'm one of the managing partners with Cashflow Champs. Primarily, I focus on the acquisitions and the asset management. So I typically oversee deals that are coming in and deals that are already underway. Paul and Prashant, they both tag team our investor relations side. So if you do wind up coming in the deal, there's a good chance that you may at some point be connecting with them. And Ryan oversees our general business operations. He's really in charge of steering the ship. And Brian and Christian do our marketing and our social media. So if you've ever seen any of that, you've probably got them to thank for it. And then on the right side, we have Adam Bolsinger from Investor Boardroom, who we're partnering with on this deal. And for me personally, I've worked with Adam on many deals, as has some of our other partners. and we're looking forward to a collaborative experience. And Jason's also part of our team,
Right.
so you'll see him very active in this deal as well.
Great. So yeah, let's go over our track record. Once again, you guys, we have 17 deals completed to date. We have gone full cycle on 8 of those deals, so we've definitely been on this merry-go-round multiple times. You are not investing with a rookie team, which is very important. Again, we have 1,582 units under management, 143 million uh, assets under management, and we have assets owned in North Carolina, South Carolina, Georgia, which is important. This is not our first deal in Georgia, Florida, Texas, Indiana, and Arizona.
Just want to mention one quick thing, Jason, on that. So, of those 8 full cycle deals, I think one thing that's really important to note is that 4 of them are actually in the Atlanta market. So, the Atlanta market is one we know very well.
Yes.
And on those deals, the annual returns ranged anywhere from 19 all the way up to 37%. So, we feel very, very confident in the Atlanta market. We have a good team there. And one more thing that's also worth noting is this slide actually needs to be updated because we recently closed another deal in the Atlanta market, and we're using the same property management company that's going to be managing this property. So we have, we have a team there, and we feel very, very confident in that market.
Nice. Okay, so now let's go over the market analysis. I'm not gonna bore you guys with all the facts of why the Atlanta market is just a grandstand market to be investing in, but let me start by saying what you don't want to invest in is a market like Detroit, Michigan back in the 1970s. So a lot of people here don't know that back in the 1950s and prior, Detroit, Michigan was actually called the Paris of the West. That's what Detroit was called back then. Um, as you guys know, nowadays, Detroit is nothing like Paris. That is because Detroit was focused or heavily concentrated on this one industry, which was the automobile industry, and when that industry left in the 70s, the whole economy collapsed. So that's why we love the Atlanta market, it's because it's a very diverse market. Um, we'll go into more into like the industries that are in the Atlanta market, but on a very high level since 2000, the population has grown in Atlanta by 18%, you guys, and that's very important because real estate is for the people, meaning without people, real estate is useless. So as the population increases, that means that we're gonna have more rental demand, which increases the rent, which increases your property value. Also, another thing to know is that Atlanta is the 8th biggest market in the whole nation. Another thing to note is that um, Atlanta has the busiest airport in the whole world. That's important because our property, Archway, is only 15 minutes away from the airport, which means that rental demand is going to increase there because there's more jobs coming in there, mostly from Delta. Delta is one of the biggest employers there, which is going to again increase rental demand, which increases rents, which increases property values. Okay. Um, and then as you can see here, Atlanta is one of the most business friendly markets in the whole nation. That's why we have so many big companies that call Atlanta, Georgia home. You have Nike, Microsoft, Google, Home Depot, Walmart, so on and so forth. As you can see, that's a very diverse industry. Which goes right to my point that you never want to invest in a market that's dependent on just one industry, and that's why we love Atlanta because it's very diverse. Here's another example of the biggest employers in Atlanta. As noted, you have Delta, which is one of the biggest employers, which is close to the property that we are closing on. I mean, you have Home Depot, you have AT&T, and the other um big companies noted here, and as you can see, uh, the industries are very diverse. Okay, so let's go into the property description. Again, this is 106 units, 1972 built. There's 14 buildings and very favorable unit mix as well. Okay, so here's some pictures of the property. As you can see, there is a very nice clubhouse, a nice playground, a nice laundry facility. All this is very important because this really encourages our strong community feel at this property. Okay, and then of course we have a beautiful pool here where our tenants can come and enjoy during the hot summer days. Okay, and here is an example of one of the renovated units. As you can see, this is very typical in both the Midwest and the Southeast markets. You have vinyl plank floorings, black on black appliances, with the countertops and painted cabinets as well. Oops. Okay, and then here's more pictures of the property. Here is the unit mix, and here is something that's very important to note, you guys, is that we have a great unit mix here. As you can see, there's only 24 one-bedroom units. You never want to invest in a property that's more than 50% of the total units are one bedrooms because that tends to attract more of a transient tenant base. So here we got a great unit mix. Okay, and here is another very important thing to consider is here is our current rent. We are at 1,393, and we're gonna push it up to 1,535. And Charles can talk more about this, but we feel confident about this because our rents are not even at the peak of the market, right, Charles?
Jason, that's correct. So with these rents here, we feel there's a lot of room based on comps we have in the submarket that are achieving these rents right now. And I think a hot topic on everybody's mind recently has been, well, what happens if rents fall? And that's certainly been a topic that's top of mind for us as well. So, in general, what you're going to see in many markets is you will see the highest renting properties start to fall. You're not necessarily going to see rent drops straight across the board, but what you need to do is see an equilibrium in the markets and submarkets where it gets to a point that it balances out with what people can afford. So we feel very confident based on the comps we see in the submarket that even with the targets we're projecting, we're at rents that are affordable for this particular submarket. And that's even if rents start to fall from some of the higher renting properties.
Very good point, Charles. Okay, let's continue. Okay, so Charles is going to talk more about our business plan and our projected investor returns, which is, I'm pretty sure, your guys' main concern.
Well, let's talk about this here. So, what do we like about this deal? Why should you be excited? Why are we excited? Well, I think one thing all of us have learned over the last 2 years is that debt can make or break a deal. This deal has great debt. So, in a couple of slides, we'll get into more details about that. But from a high level, this deal has, a loan assumption with a senior loan and a supplemental loan, both Fannie Mae loans, that have a blended rate of 3.79%. They still have a little bit of interest only left. They have roughly 7 years left on the term, and it's about 73% LTV. So what that tells me is based on the price that we're paying at 73% LTV, we're getting a reasonable amount of leverage at a great rate with plenty of time left. And that's something that's very, very important to any deal that we're looking at, and we would recommend people doing the same as they're looking at deals now. The second thing we like is cash flow. So with any deal, having cash flow is certainly a plus. So we're projecting a cash on cash return that's north of 7% over the projected 5-year hold period. Now, that doesn't mean in year one it's going to start out that way because this is a value add deal, but it is something that we expect to have over the life of the hold, which is great. And the third thing is the sellers already put some money into the property. So they've upgraded approximately 60% of the units, and they've done some type of upgrade to these units based on what they've needed. So you can see in the middle of the slide, we have our projected returns for this particular deal. And we'll talk a little bit more about that as we go through the plan further. Jason, next slide.
Uh-huh.
Okay, so this here also outlines some of the points that get us excited about the market, and Jason talked about some of these things already. So Atlanta is the largest city and the number one ranked state for business climate. So earlier in the presentation, there was a slide that mentioned that there was 29 Fortune 500 companies headquartered in Atlanta. That is not by accident. Okay, companies that big don't pick locations to headquarter randomly. There's usually a lot of thought and a lot of research that goes into that process. Some of the companies you saw in there were Delta, UPS, Coca-Cola, Home Depot. These are all major companies that I'm sure just about everybody here has heard of. Another thing we like is accessibility. So with any property in any market, it becomes more desirable the closer it is to jobs, the closer it is to retail, the closer it is to things that people need to get to on a regular basis. If it's easier for somebody to get from your property to where they work or where they need to go, there's a much higher probability of having renters at that property on a regular basis. So this particular property is right near I-85 and also I-75. Those are two major corridors in the Atlanta market, and both within proximity to a lot of blue-collar jobs. And then also we have the submarket. So what's happened in this submarket recently? Well, since 2013, keep in mind, we're in 2023 at this point, so that's a decade. They've had average effective rent growth of 13% a year. That's a lot. That's a very large amount. Now, is it to say that we're underwriting for 13% rent growth each year? No, absolutely not, because we don't believe that's something that's going to continue being sustainable. But I think it's a very important point to note because it shows the strength and the resilience that the market has had over such a long period of time. Jason, next slide, please.
I just wanted to add to Todd's point is that we're being very conservative with our underwriting, despite the fact that um average effective rent has increased by 13% since 2013. We're actually underwriting with only 3% rent growth in years 3, 4, and 5. So, so that's why I'm very confident that we can still have room to actually outperform our projections.
Okay, so the approach we're taking here is really a three-pronged approach. The first one is operational efficiencies. So we're going to go in there with our management team and be able to streamline certain things so we can really maximize the income and reduce the expenses to bolster the NOI. The second one is the value add program. So as we mentioned, the seller's already upgraded approximately 60% of the units. So that means there's a lot of work that's already done that we don't have to do heavy lifting on. But there's still some work to be done, and that we have factored in, and that's part of our plan. And then the third prong is raising market rents to levels of where the comps are. And there are several comps in the market already getting these higher rents. So again, we feel very confident achieving them based on the market knowledge we have and based on the data that we've seen. Next slide. Okay, so in this slide, we're going to talk a little bit more about the debt. So for simplicity, we consolidated both the senior and the supplemental mortgages into this slide. The senior mortgage is $6,885,000, and the supplemental is $2,897,000, and the blended rate between both is 3.79. That's a great interest rate for anybody who's out there looking at financing now. If you're in the multifamily space like we are, you're probably seeing new financing range anywhere from maybe 5.5% on the low side to 6.25 or 6.5. And that's if you're staying with the agencies. If you start going to the banks or if you start going to the bridge financing for short term, you're probably even higher than that. So 3.79 is quite attractive in the current day and age. We have interest only through November of 2024, so that's going to give us some good runway as we work to stabilize the property after closing. So that gives us a little bit of cushion to be able to really get the property moving in the right direction. And we have time. Keep in mind, one of the biggest challenges that a lot of deals are facing right now is they're running out of time. You have a lot of deals that have loan maturities coming up. Well, the good news is you don't have that here. You have more than 7 years from the time we close. So there's ample time to execute the plan and also to allow the market to rebound. And if I didn't note this already, it's worth noting that interest rate is a fixed rate. So that rate is not going to change throughout the life of this investment. Jason, next slide. So here we can see the sources and uses. So on the left side, we see all the different sources of capital that will be involved in the deal. We have the 2 mortgages that we're assuming that were already in place. We have preferred equity, so that's still being finalized. We're negotiating with a few different groups to work on getting the best deal. And then we have common equity. So the common equity is what we're here to talk to you guys tonight about, because that's how you guys can get involved in this opportunity. And then on the right side, you can see how the capital is going to be deployed. The largest portion is the purchase price, and that's going to be going to acquire the asset. Then we have nearly $1 million of CapEx that we're going to be putting in. And we have a slide that will talk a little bit more about that shortly. We have closing costs. In those closing costs, we have 12 months of real estate tax and insurance escrows. At closing, we know that the lender is going to withhold a certain amount of each because they're going to have escrows that they establish. So we want to make sure there's ample money to do so. And we have an operating reserve. So the operating reserve is roughly 8 months of the pro forma expenses. Why do we need so much money? Well, you need money because things happen. And you want to make sure that you're prepared to weather a storm. One of the real value adds here at this property is cleaning up a lot of the delinquency that exists. So having that money helps us be able to transition those units and get better qualified tenants in there so we can ultimately make the property perform the way that it should be. And then there's also an acquisition fee. Next slide, please. Okay, so here we have our CapEx. So you'll notice that the items are actually listed from the highest dollar amount to the lowest. And we'll talk about some of the bigger ticket items just so everybody has an understanding of what's involved. So the largest item we have is roof work. And with this particular property, we assessed that 4 of the residential buildings and the leasing office building need to have new roofs. So there's just shy of $200,000 budgeted for that. We have unit turns. So with these turns, that'll be an ongoing thing. Many of the turns throughout the first year or so are probably going to be capitalized. And we're also expecting that for many of the tenants that are carrying high delinquent balances, some of those turns may be heavier because there's a lot of times in situations like that where tenants leave those units in worse condition than they should. We also have some exterior drainage. Those are the French drains to be able to make sure that there's no problems with water or erosion at the property. And then another thing we have is a partial fence and gate system. So this property has multiple entrances and exits. And one thing we feel that would really benefit both the residents and the property is by enclosing it with some privacy. And by having that partial fence and gate system, what it does is it allows you to be more selective over who's going into and out of the property. And it also gives the residents and the property a more exclusive feel. Next slide, please, Jason. So here we have the underwriting. And Jason mentioned a little bit about the rent growth, but let's touch on a few points here. Okay, so the first thing we have in year 1, you can see that between physical vacancy, concessions, loss to lease, bad debt, we have nearly north of 26%. Okay, so that's a large number. Why do we have so much? Well, the reason is because of all the delinquency that currently exists. We know it's going to take us some time to go in there and correct it. We've done this in the past at other properties, and we expect it's probably going to be a 12 to 18-month runway before we can really get that problem corrected and get the property moving in the right direction. So what you can also see is that while we do have a value add bump in year 1 and year 2, there's no annual escalation. From that point on, we're using 3% thereafter, which is very reasonable based on past performance in the Atlanta market. And on the expenses, a couple of things worth pointing out. One thing we always like to do is make sure that we have plenty of money to run a property. One of the worst things you can do is run out of money, because if you run out of money, you're in a very bad position. So with the expenses at the property, one of the things we did is we always like to use the seller's numbers as a starting point, because that gives us some context of how we might be able to run the property. So this particular property has operating expenses that are right around $8,000 a unit. For anybody familiar with the Atlanta market for a C property, that is definitely on the high side. One thing that's worth noting that we don't have budgeted for in the projections here is that the tax bill is actually going to be a little bit more favorable for years 1 and 2. And the reason for that is the seller actually had a successful tax appeal that concluded after we prepared this material. And it'll be somewhere in the vicinity of $155,000 for the first 2 years. So that's a big win. That'll save us about $35,000 in those years. Payroll, we have plenty of money in that. It's probably no secret to anybody here that costs have been going up the last few years. And one of the largest costs that have been going up are wages. So to attract quality talent and to be able to retain them, you need to offer them a competitive package as they would get with any other employer. So that's why we have ample money in there for that. Jason, next slide, please. One more thing that's worth pointing out also about the property, there's a lot of townhome units on this property. So townhomes have always been very desirable, but especially in the post-pandemic world that we live in now, people like space. So this property has good spacious floor plans. It gives you ample room, and you can really get, a nice living environment for a couple or family, that appreciates that extra space. So now in this slide here, we're going to talk about what the returns would look like if you invested $100,000. So if you invested $100,000, what what would you wind up with? Well, what we can see is in the third row down, you see the member cash flow, and that shows you approximately the cash flow you would get each year. So in year one, you would get approximately $4,000, and you'll notice that steadily rises throughout the life of the investment, with year five being just over $9,000. So between the 5-year total, we would project approximately $36,700 in cash flow being distributed to a person who invests $100,000. And then on the backside, we would predict a lump sum of north of $55,000 from the sale of the property. So between both the cash flow and the proceeds on sale, it would be approximately $92,000. So you're seeing an average annual return north of 18%, an IRR north of 15%, and an average cash on cash return north of 7%. Next slide, please. Okay, so now we're going to talk about some of the different things that our team will do for you. So the first thing is due diligence. And Jason and I can both attest to that. We were out there on May 11th. We were doing due diligence with the property management company. And they were actually out there a few more days. And they were there 3 days, and they probably had about 30 vendors go out to the property during that time. So we inspected all of the major systems, and we also did a financial due diligence. So we went through all the leases, we did an audit on those, and we went through past financial records to make sure the financials presented to us were accurate. So we'll also give you updates. You're going to get updates on a regular basis. You'll receive a monthly update and a more comprehensive quarterly update. We'll be making site visits. So the site visits will vary depending on how often they're needed. So as the property is first acquired, the site visits may be a little more frequent because there'll be some more transition work going on to get the delinquent tenants out of the property and get better qualified tenants in. And then they may be a little less frequent as the property becomes stabilized. So one thing we always do, and what really our most important thing, is oversight of the property management company. So we're going to be working hand in hand with them. Our job as the asset managers to chart the course. Their job as the property managers to go out there and execute it. So we're going to give them the direction, and we're going to hold them accountable to make sure that they deliver on the execution of that plan, and to make sure that our goals and objectives are met for the property. And the last thing is cost segregation. So one of the best reasons to invest in real estate is tax benefits. And Jason can probably talk more about that because he's the accountant. But everybody likes saving money on taxes. So I think that's something we could all agree upon, and probably something that each and every person watching this could benefit from.
Yeah.
Next slide. Okay, so we'll do a recap here. So the returns for this particular deal, north of 15% IRR, north of an 18% average annual return, and north of a 7% cash on cash return. The cost basis, average comps, if you look at some sales comps in the market, is selling around $140,000 a door. We're at 126. So that gives us some downside protection, not to mention great debt. CapEx. So with any investment, you need to invest back into it. You need to reinvest to make sure that the investment stays strong. And that's whether it's a property, whether it's a business, but also what it may be. So we have ample CapEx that we're planning to reinvest back in the property. Financing. I don't think I could understate or overstate how attractive the financing is. And I think that's really the key to why this deal works. If you were out there now trying to source new financing, it probably wouldn't make sense. But because we have great financing that was obtained at a point when interest rates were very, very low, that gives us a great opportunity to benefit from that with plenty of time and a great rate and good leverage. Okay, so then what else do we like? Well, property and location. As Jason said, the Atlanta market is one of the most desirable in the entire country. So in that second point down on the right side, you'll see major development 6 West. So for anybody unfamiliar, you should Google that project, and you'll see the enormity of that particular project. So why is that important? Well, the Atlanta airport that Jason mentioned is not only the busiest in the world now, it's been the busiest airport in the world for at least the last 23 consecutive years. And that's as far back as I've looked. Perhaps it's even further than that. Okay, so for the last 23 consecutive years, it's been the largest and busiest airport in the world. So what's happening is with 6 West, it's a major development that's going to bring a lot of new blue collar jobs. This property is about a 10-minute drive from that airport, and the property really has a good fit for a blue collar working person. So as you see more and more of those blue collar jobs open up in the area, and you don't see more new supply coming online to accommodate them, what will happen is all of the existing workforce housing properties are going to be that much more valuable because you have all these tenants that are going to want to live close to where they work. So another thing is location. 20 minutes to Midtown Atlanta. So Midtown Atlanta is where you have the nicer office buildings. It's where you have a lot of the nicer restaurants. So this property is about a 20-minute drive from that, and roughly 12 minutes from the airport. So keep in mind those are with relatively normal travel times. Similar to many of the other major markets in the U.S., Atlanta has no shortage of traffic. So if you go at the peak hours of the day, you'll probably find those times will be a little more elevated. And again, townhome style floor plans, very desirable. People like these, always have, and they like them even more nowadays. And the property itself, it's 10 acres, so you're not living right on top of each other. There's plenty of room for the residents to have their own personal space. And then you also have amenities. Next slide, Jason. So some more photographs. On the left side, we can see the beautiful landscaping. You can see some of the retaining walls, and you can see the leasing office. So overall, a nice photograph showing some of the exterior conditions of the property. And then on the right side, you can see the game room, which is in the leasing office. They also have a clubhouse area. You can see a billiards table. You can see foosball. So it gives spaces for the residents to go and to connect with each other and to have fun. Then the pool and the playground, then also the laundry facility. Next slide. So where could we potentially do better than what we show here? Well, one is that the returns are potentially higher than what they could potentially be a little bit higher than what we're showing. Second thing is that the underwriting is at 75% of the rent increases and a low escalator compared to historical trends. If we see 13% annual growth continue in this submarket, we could do far better than what's shown here. Even if we see 5% annual growth, which you could argue is very conservative based on the last decade of growth in that submarket, we can still outperform what we show here. Another thing is the operating reserves. So we want to make sure there's plenty of money so that way the investment's safe. And that's something we feel very confident in. Terminal cap rates. So for anybody who's looking at a lot of deals, terminal cap rates oftentimes the difference maker between how good or bad a return is going to be. And the terminal cap rate is what you're projecting to sell the property at in the future. So in the last year and a half, cap rates in every market throughout the country have decompressed. So that means cap rates have went up, prices have went down, and that's no different in the Atlanta market. If you were looking for a similar property 18 months ago, you'd probably be in the 3 to 3.5% cap. So that's a big change. But we've used the 6% exit cap, and the reason we've done that is because C-class assets in the Atlanta market right now is selling between 5.25 and 5.5 cap rates. So we want to make sure there's some protection there. We're buying this property in the mid 5% range, and we want to make sure that there's protection for our investors and also for ourselves as we go forward into the future with a lot of uncertainty. Another thing worth noting is the underwriting we presented versus the underwriting that our property management company came up with. So there's actually some things they're a little more aggressive on than we are. We didn't feel comfortable with those, so we don't necessarily present those in our underwriting, but they actually show lower vacancy rates throughout the future years of the investment. So again, that's another area we could potentially do better on. Next slide, please. Okay, so then we have some frequently asked questions. So keep in mind, guys, we will distribute this to anybody who did put their information in the chat box, so that way Jason can send it to you. but a couple of points that were worth mentioning. So break-even occupancy. There's a lot of people that are very concerned with stress testing, and with good reason. So one of the metrics we like to look for is break-even occupancy. So what does that mean? Well, that means if things went wrong at the property and we had a higher amount of vacancy than expected, what occupancy would the property have to be at for us to actually be in the red? And the answer here is in year one, 57%, and year two and three, 62.5%. You can go back and look at any recession in U.S. history. You can even look at any depression in U.S. history, and you will not find occupancy rates that low. Now, could there be challenges? Yes. But the good news here is that this property is equipped to stand the challenges. So if an occupancy gets that low, let me reassure you, it has nothing to do with a recession. That has to do with the management issue. So we feel very confident in being able to keep occupancies above that. Another question here that people are probably going to be wondering about is, when did distributions start? So with this deal here, distributions will begin after the second full quarter of operations is completed. So right now we're in Q3. So we expect to close the deal midway through Q3 of 2023. And then Q4 and Q1 of 2024 will be our first 2 quarters. So you would expect your first distribution to be paid somewhere in April 2024. And will the sponsor be investing in the deal? The answer is yes. We do invest in all of our deals, and we'll probably be in there for somewhere between 5 and 10% of the equity. Next slide, please. Okay, next steps. Well, let's go review those. Next slide, Jason. So if you're excited about what you saw here tonight, what you need to do is reach out to the person that invited you and request access to the investor portal. We use Cashflow Portal for this particular investment. So what will happen is, if you reach out to Jason, he'll send you a link, and you'll be able to create a profile on the portal, review all the offering documents. If you choose to, you're more than welcome to share them with your financial professional, be it your attorney, your accountant, your spiritual advisor, whoever it may be, and to get their guidance on it. And then if you've reviewed the documents and you decide that you want to move forward, there'll be an e-sign subscription agreement. That's going to have some questions about you and the financial qualifications you possess, just to make sure that you're able to invest in this particular deal. And then after you do that, you'll receive the wire instructions, and you'll be able to transfer your funds over to the investment. Last thing you'll need to do is, being this opportunity is a 506C, is you will need to verify your status as an accredited investor. This can be done one of 2 ways. Through Cashflow Portal, there's an affiliate service called Parallel Markets. You can do the verification process through that, or you can simply upload a letter from your accountant or other financial professional that's familiar with your situation. Next slide, Jason. Okay, so why don't we open up for questions and comments? Jason, I can't see if there's any questions in the chat box, but if you see any on your end, maybe you can just let me know on that.
Yeah, so while we wait for that to fill up, I just want to go over some more frequently asked questions that I get on a daily basis. First one is what is the minimum investment? It's $50,000. Another frequently asked question is, when is the deadline for this? So I would like to say that our closing date is going to be August 17th. However, this is first come, first serve, and in the next week or so, we're already gonna get a big investor to invest in this deal, and we're already getting a lot of interest in this opportunity. So I would hate for you guys to miss out. So I would strongly suggest that you guys act quickly and you guys take action now. Okay, so let's see if there's any other questions. I don't see any other questions, so I think we're good, Charles. So
Well, I'm just going to echo what Jason said on that. So keep in mind, guys, we do expect this investment opportunity to fill up fast. We encourage investors to get funds in typically 2 weeks before closing. And the reason we do that is we want to avoid any last minute scrambling. So we do encourage, over the next 2 to 3 weeks, if you're interested, feel free to reach out. Jason or myself will be glad to help you with any questions you have. And, we'll look forward to having you in this deal with us.
Yeah. So, thank you again, everybody, for joining us, and thank you, Charles, for making time for this. Thank you. All right.